All right, so for today's presentation or lecture, I wanted to discuss how to value a company. And I thought this was a good topic because I myself am a finance student and I'm going into the investment management space. And this is obviously a key to being successful in that space. And I feel like I know these concepts pretty well for a student at my age. So yeah, I wanted to go over the concepts and there's kind of three main valuation methods. There's DCF or discounted cash flow, which is the one we'll cover today. There's public comps and there's the precedent transactions. And today I'm covering the DCF, as I said, because it's kind of the most important and the most used one. So yeah, let's get right into it. And just to add on, throughout this, we'll kind of be going from presentation to Excel, just showing you how I'm filling out the DCF. But yeah, you'll figure that out as we go along. So I'll walk over the steps of how to kind of perform a DCF analysis, and this is quite basic at the moment because of our time constraint, but it's definitely should be good enough to kind of get people started on this topic. So yeah, for step one, you kind of just want to forecast the required financial numbers. And for DCF, there's actually not as much information as you would think that needs to be forecasted. So the first thing you want to forecast is revenue. So these are all the historical numbers, like from 2018 to 2020. These are all historical numbers right here. And then you want to forecast future numbers, and we'll just do that in a basic way where we'll use a growth rate based off of um, like the previous year's revenue number and just paste that across in Excel. And obviously, this is a very basic method of doing it, but I'm just showing you how to, kind of forecast the revenues in the most basic sense. So the next thing is you want to forecast your EBITDA or EBITDA margin. And the way you do that is like, again, I just pasted some random numbers here in the red, and using off of those assumptions, I'm just going to calculate an EBITDA margin, which is essentially the um, revenue figure multiplied by the assumed EBITDA margin in the forecast period. Um, and I will go do that. And then same thing for EBIT. It's pretty much the exact same calculation. Just do that. There you go. And then yes, the tax rate. This is just like a basic tax rate. I got it off of the Bloomberg terminal, which is kind of like um, it's kind of like a source of a lot of financial knowledge, and that's where a lot of financial analysts go to get their information on companies. So yeah, I kind of pulled this information from Bloomberg. And the last three things we're forecasting are just depreciation and amortization, change in working capital, and capital expenditures. And again, these forecasts right here in the red, they're just numbers I pulled from Bloomberg again. Usually, there's a lot more thought that would go behind this when you're actually doing a proper analysis of a company. But for today's sake, I'm just showing you a very basic method, as I've said. So yeah, we're done step one. Now we forecasted all the required information. Step two is we need to calculate the free cash flow to firm. So the free cash flow to firm is kind of the free cash flow that's available to both equity holders, which are the people who buy the stock in the company, like the shares, and then debt holders as well. So the people that buy like bonds or whatever from the company. And we want to calculate that because that free cash flow amount is what's going to help us forecast or determine the company's kind of implied value, which we'll get to later on. So what we want to do there is we already have all these uh, like the needed financials. So first we want to calculate NOPAT or net operating profit after tax. And that calculation is quite basic. It's just EBIT multiplied by 1 minus the tax rate. Okay, and we'll do that for historicals and for future periods. And there you go, we got our NOPAT. All right, and then the next thing we go down here, and this is the free cash flow to firm. And the formula is pretty basic. It's just this NOPAT plus depreciation and amortization minus the change in working capital and then minus capex. Or in this case, it would actually be plus capex because the capex number is already negative, and it would be plus this because that number is already negative as well. So Yes, there you go. That is our thing. I'll just make these pluses, make that a plus, and make that a plus in this situation. All right, so now we have our free cash flow to firm for both the historical years and the forecasted years. So now we go on to step 3. So now we calculate the discount rate, and the discount rate is described as the required rate of return for an equity investor for like any company that has like a similar risk profile to the company that we're analyzing. And by the way, the company that we're analyzing, its name is Dental Corp. It's a Canadian company. Sorry for not mentioning that before. And because we don't have much time, I again just pulled the number from the Bloomberg terminal, and it's 7.4%. And then once we have this number, we want to discount these forecasted cash flows back to their present value. So this is where the time value of money concept comes in, where money today is worth more than money tomorrow, essentially, because money today you can earn interest on it, but money tomorrow you won't be able to earn interest. And we just need to kind of bring these numbers back to their present value and see what like something like $127 or $127 million in free cash flow in 2025, what would that amount equal in today's money given this discount rate? So the way we do that is we would lay out these discount factors, and the calculation is pretty simple. It's just 1 over and then bracket 1 plus this discount rate, and we'll just hard code that to the 1. So this 1 to 5 right here, this just represents the years in the future. So this is 1 year and it's 2021, 2 years, 2022, it's pretty intuitive, it's pretty basic. So there you go, we calculate our discount factor and just paste that across. Those are our discount factors. And then what we do is we just multiply the free cash flow to firm for each year by the discount factor for that year. And there you go. We have our discounted free cash flow to firm. So this shows that like this $127 million free cash flow to firm in 2025 is actually worth, in today's terms, is worth about $89 million given this discount rate. So yeah, now we have the discount rate and we've calculated the present value of the free cash flows. So we will move on to the next step. Let's see. All right, so the next step is to calculate the terminal growth or the terminal value. And the terminal value is essentially the value of all the free cash flows after 2025 into perpetuity. So it determines the value of the company after the explicit forecast period. And this concept is used because after that, 5 to 10 year period, it's obviously very hard to forecast where a company is going to go because it's so far in the future. So you just assume like a basic, very small amount of growth in free cash flow per year, and then you discount that back to the present value. So I'll just show you how to do that. We'll calculate the terminal value right here. So the calculation is you want to get the free cash flow from 2025, or like the last year in your explicit forecast period, multiply that by 1 plus the terminal growth rate, and then you divide that by the discount rate minus the terminal growth rate, and there you go. That's your terminal value. So that is the value at 2025 of all the free cash flows that you will get from 2025 into perpetuity, if that makes sense. And then you also want to get the present value of that. So you would do this divided by 1 plus the discount rate to the 5, which gets you that number. Or you could just multiply this by that, and it's the exact same number, I believe. Yeah, it's the exact same number, so you can do either one. So yeah, now we have the present value of the terminal value. That essentially means that whatever this value is, we're bringing it back to what it would be worth today, which is this 1,682. So yeah, now we have our present value of the terminal value, and we go on to our last step, I believe.